In our previous video, we were looking at how profitable is our organization. So we were talking about a number of ways to calculate profitability. And so we did the calculations you see on the left of the screen here. We looked at sales growth, we looked at cost of goods sold, we looked at our gross profit, gross margin, profit margin, and so on. So now let's look at how we finance the operations of our organization and what they tell us in terms of profitability. So we're going to look at the calculations for the items that you see on the right. So we're looking at the decision that management makes in terms of how we're going to finance our business. So in financial management, we need to decide, are we going to borrow money or are we going to sell shares in our organization? So are we going to add owners who will benefit when the organization profits? So let's start with the first one. Let's start with debt financing. So here we are borrowing. We can choose to have a mortgage. So if we have a property, we can then get a loan, and the bill or the property itself is collateral. That is, if we fail to pay back the loan, then the bank or whoever lended us the money takes possession of our property. We could instead do what is called a chattel mortgage. Chattel mortgage is where your collateral on your loan is something besides your building, your location. So some other kind of physical asset instead of your property. So likely you want to borrow money to buy equipment or machinery, and so you get a chattel mortgage. If you don't pay the loan back, then they repossess, they take back that equipment. So we are borrowing money. Another way to borrow money is that if you are a large organization, a corporation, you can issue bonds, and so you're essentially selling your debt to other people. The debt financing can be short-term, less than 1 year. It can be intermediate, 1 to 5 years, or it can be much longer in terms of long-term securities are 5+ years. When we start doing our financial ratio calculations, we are going to label what we call long-term liabilities as more than 12 months. So when we talk about borrowing, as we start to build the balance sheet, because before we were looking at the income statement, now we're looking at the balance sheet. The borrowing is what are called liabilities. Okay, debt financing means we have liabilities. We owe money. And so we're going to separate out current liabilities, so more short-term, with more longer-term liabilities, anything more than 12 months. So we're really going to clump these two together into more longer-term. An alternative choice would be to do equity financing, to sell shares in a company. So why might you want to do debt financing? Well, if the choice is to borrow money or not borrow money, take into consideration the fact that the cost of interest on the debt is probably lower than the impact to your organization of not being able to operate. So, for example, let's say we can't pay the rent. We could borrow money to help pay our rent, or we could just not pay the rent. Well, if we don't pay the rent or the lease on our location, then the problem is they're not going to let us operate. And if we're a Subway sandwich shop, we don't pay the rent on our location, the lease, they are going to shut us down, which means we can't produce any Subway sandwiches, which means we don't have any revenue coming in. That's no revenue to pay the rent or the lease. That's also no revenue to pay for all of the materials we need, all those fruit, all those vegetables and bread. There's no money to pay your workers. So it becomes much more costly to disrupt production than it would be just to borrow money and pay interest on that debt. Now, if you're trying to choose between debt and equity, so debt, we borrow money, maybe that's from a family member, maybe that's from a bank, versus equity, that is selling ownership in your company. Well, it's often easier to raise money with debt funding than it is from equity. So because you probably have a number of assets, that can be held as collateral. It's easier to get a bank to lend you money than it is to find people who are willing to give you their money with the promise they will get a share of the profits in the future. Because with debt, with a loan, you have to pay the bank back no matter what, no matter how well the business does. With equity, we only pay back those investors if we're doing well, if we're making profit. So it's much easier to find someone willing to lend you money, so a guaranteed payback, versus equity, that future profit. From your perspective, if you're trying to figure out, should I do debt or equity, recognize that a debt payment is a fixed cost. We borrow the money, we know exactly how much we need to pay back over time. But equity financing means that we have promised a share of the profits in perpetuity to people always in the future. And so the debt payment is for a short period of time. You know exactly how much it's going to cost you. Equity financing will continue to cost you in the future as you earn more and more profits. So many businesses would prefer to do debt financing to equity financing because, of course, anything you're not paying back to any of your lenders, to any of your investors, is money you get to use for your organization or other stakeholders. So businesses tend to prefer debt financing. If you choose debt financing, then you need to consider the interest coverage ratio. The interest coverage ratio is how well a company can pay the interest on its debts. So we take the earnings before interest and taxes, our operating profit, our operating income, and we divide by the interest. So do we have enough money to pay the interest on our debts? Are we earning enough to pay the interest? If you're not earning enough to pay the interest, you should not be getting that loan. When you think about a house and should you borrow the money to buy a home, you look at, can I afford the interest on this mortgage? Same thing here. Businesses need to have enough earnings to cover that interest if they are going to do debt financing. Companies with stable revenue should have an interest coverage ratio above 3. You should have about 3 times as much earnings as any interest you owe on the debt. Higher, even better. But a company should have at least 3 times. Instead of borrowing money from a bank or a family member, instead of using debt financing, you could instead do equity financing. That is, we are going to sell stocks in our company. We have common stockholders. Those who buy common stock get to vote, so they get a say in how our business operates. If you are a preferred stockholder, you are a non-voting member, but if our business goes under, you have a superior claim. So that is, if there is a financial issue and we can't pay out to those who own stock, preferred stockholders get paid first. Okay, so we have 2 different types of stock that we can issue. Where can you get equity? Where can you find investors? Well, there are small company offering registrations, so-called SCORE, allows companies to issue common stock without doing an IPO, so initial public offering. So the idea here is to make it easier for small companies to sell or issue common stock. Big companies have what we call an IPO, initial public offering. You can also find venture capitalists. They're looking for rapid growth in terms of investors. We have angel investors, high-income individuals, people looking for high risk, high return. This would be like the people on Shark Tank or Dragon's Den, right? They are looking to invest in an organization. They want to see a lot of growth very quickly. They want to put money in, get a high return, and pull out. So different sources of investors. There's also small business investment companies, so companies that are willing to invest in the growth of other businesses. And then employee stock ownership plans. So you can have it so that the people who work for your organization are paid out in terms of benefits, the option to purchase stock. Okay. So you're deciding how you are going to fund the operations. Are we going to have loans? Are we going to have investors? If you are going to go equity financing, then you need to look at things like earnings per share. Earnings per share takes your net income, that profit after taxes, and subtracts out any preferred dividends. So those who have preferred stock get paid first. Everything left then is available to those common stockholders. And if we take that and divide it by the number of common shares, we get to know the amount of earnings per share. What's the value of the organization per stock that you own? And the earnings per share should increase exponentially over time. We want the profits to grow faster than the number of stock. This encourages more people to invest in your organization. So they want to buy your stock, which means you have more money to fund your operations. So we want an earnings per share that's going up quicker and quicker and quicker. You'll see here in this report from Google what is called basic earnings per share and just earnings per share. The earnings per share that you see here includes the ability to exercise stock options. So if you are paying people, your employees, you're giving them a benefit, which is the ability to buy stock, then we calculate the earnings per share. In that bottom of that calculation, we would include not only the common shares that are out in the world, but also the stock options that have yet to be exercised. So you have the right as an employee to buy stock, so we should include that then in the earnings per share. That's the numbers on the bottom. If you look at simply the number of stocks, common stocks that have already been sold, then that's the top number. So of course, if you're dividing by a bigger number, your overall number is going to be smaller. So the earnings per share that include the stock options are always going to be a smaller number than the earnings per share itself, the basic ones. So notice over time what's happening to earnings per share. In 2017, they're 91 cents. By 2021, 5.69. So we're looking for that exponential growth to encourage more people to be investors to provide funding to the organization. Here you can see Amazon. Here we have the basic earnings per share. So again, if there are stock options, that's that one on the bottom. The basic earnings per share doesn't include the stock options. Notice we go from 32 cents to $3.30. So if you want more people to give you money, you need that earnings per share to go up quicker and quicker. We can also look at what is called the price earnings ratio. The price earnings ratio is the stock price divided by the earnings per share. So the idea here is that if you are looking for people to invest in your organization, then we need to look at what the market says the value of the organization is versus what the earnings per share says that the organization is worth. And so if we look at the price earnings ratio over time, it can tell us when the market is not quite in alignment with the financial status of the organization, the earnings per share. So that might tell us when that the market price is under or overvalued. So for example, if we're looking at Amazon here, and we're looking at the price earnings ratio. So our price earnings ratio here, let's look at 2020. In 2020, if we look at our graph, so let's look about here at our graph, the end of 2020, so even further over here, we can see that really the price in the market for stocks for Amazon is about 150 bucks. The earnings per share at the time are $2.13. So that means our price earnings ratio is 70.42. In 2021, so we'll look December about the same time, you'll notice that the price, the market price, the stock price, is not that different, still sitting around 150 bucks. Okay, the earnings per share is now $3.30. So 150 divided by $3.30, we get 45.45. So notice that the price earnings ratio is going down. If the price earnings ratio is going down, then what that indicates to us is that the stock may be undervalued. So the stock price, the 150 bucks, hasn't adjusted for how well the organization is doing in terms of the earnings. Sorry, my brain just died right in the middle of that. In terms of the earnings per share. So we can see that the stock price hasn't changed. The earnings per share has gone up. So the market price hasn't adjusted for that fact. So our price earnings ratio is falling. So the stock may be undervalued, which means investors are encouraged to buy, to get in and take advantage of the fact that that stock price hasn't gone up yet to match that earnings per share. If the price earnings ratio is rising, then the stock may be overvalued. We'd expect that stock price of the Amazon stock to fall in the future. So it's telling you should sell now because the stock price has not yet adjusted for those earnings per share. So looking at these calculations like price earning ratio, like earnings per share, we get information about the profitability of the organization. And really it's coming back to the question of how this business is going to finance its operations with equity, with debt. And if you're going to do it either way, you need to either convince people to lend you money or you need to convince people to invest in your organization. So we need to be aware what's happening in terms of the financial ratios. We'll look at two more financial ratios here. I think that's what I got here. And so we have, four. So we have a return on equity. So how much money is generated for every dollar that's put in. So if we have people who are looking at being investors, so we're looking at the average in terms of the equity, and we're looking at our value of our organization, our net income minus the preferred dividends. So that's the amount that's available to those investors. So this looks at how much money is generated for every dollar that comes in terms of the investors. So return on equity. We also look at a payout ratio. If you think about maybe you're choosing who to invest in based on whether they pay dividends. That payout ratio looks at the percentage of profits that are not reinvested and are instead paid out. So we take the cash dividend, the amount paid out, divided by net income. Higher payout ratios, of course, encourage more investors because when you're picking what your investments are, we like ones that pay us dividends, gives us money that we can then use to buy more investments. We can also look at the book value per share. So this is the minimum value of a company stock. We look at our equity divided by the number of shares outstanding. So what is that value per stock? This tells the minimum value of that company's stock. If the market price is less than the book value, then it's undervalued and we should be buying more of that stock. We can also look at dividend yield, right? So we can look at the common dividend divided by the stock price. So what percentage of the stock price gets paid out. So again, informing investors as to whether or not they should be giving you their money. So we've looked at our decisions. Should we borrow money? Should we get investors in our organization? And we have looked at a number of the different ratios that tell us about whether we can afford to borrow money, whether we can entice people to invest with us. When we look at equity and we look at debt, these really belong on the balance sheet. And so when we look at our balance sheet here, we have assets, liabilities, and owner's equity. So let's just go through each of these in terms of what they mean. So a balance sheet is a snapshot of how our assets are being used. It helps us gauge the financial position. The liabilities and owner's equity are how we get money for the organization. And then the assets are what we do with that money. So we have cash. So if you think about your business, if you are working retail or at a restaurant, right, you need cash on hand to give people change. So that's going to be some of our assets. We have some cash. We also have what are called accounts receivable. So accounts receivable are where we need to receive money from customers. So customers owe us. We've sent them a bill. They have yet to pay us. That is what is called accounts receivable. We also have our inventory. It consists of both raw materials, work in process. So if we're thinking about our gingerbread house, we have raw materials. We have our crackers. We have our candies. We have our work in process. That's the partially created gingerbread house. And we have our finished goods, our finished gingerbread houses, and that's going to make up that total inventory. We might have some prepaid expenses, things we've already paid for, but have yet to get the service or the items from that. We will also have fixed assets. So our fixed assets are things like our building, our equipment. They, of course, lose value over time, so we have to subtract depreciation, and that gives us our net fixed assets. So that is the value of the organization in terms of what we have. And then we have the way that we funded that value. And so we have our liabilities. So our liabilities, we have accounts payable. So this is the amounts that we, the business, need to pay. Okay. So where accounts receivable is other people owed us money, accounts payable is where we owe others money. Accruals are things like salary, where people have worked for us, our employees, and we have not yet issued them their paycheck. Maybe we pay them every 2 weeks. And so we owe them money, and so that is a liability. And then we have our notes payable. So this is our loans coming from family members, coming from banks. We are going to separate, as we said before, the liabilities into long-term, which are going to be really those loans, those notes payable that are more than 12 months. Okay. And then we have equity financing. So we have common stock, maybe we have preferred stock, and then any money that's left over is going to be retained earnings. This is money that we have not given out to investors or owe in terms of loans. It's simply money that we have within our organization that we have retained. As we are looking at our balance sheet, there are some other calculations, measurements we can do. So in our next video, we're going to look in detail at financial ratios. But before we do that, let's just look at, make sure I have all my pieces here. Let's just look at a couple pieces related to the asset side before we move into a lot of the financial ratios. So we can actually see some examples here of balance sheets. This is Amazon and Google. You can see how they've broken down assets into current and long-term. And you can see the liabilities and equity as well. If we look at the assets, we can see they have property, plants, and equipment. They have long-term investments, goodwill, and intangible assets. So we can see here total assets, total liabilities, and we have our equity. So you can see that on their balance sheet, the assets equal our liabilities and our equities. You can see here, Google, same thing. You can see they have the cash on hand, accounts receivable, some prepaid expenses. So a number of the pieces that we have been talking about. Before we dive into our next video and dive into financial ratios, let's just look a little bit more at the idea of inventory. So as we look at asset management. So if we're focusing here on the asset portion of the balance sheet, we can look at how well our organization is operating based on how well we use that cash, that inventory, and so on. So burn rate is a calculation where we look at, is our cash being used faster than it's been generated? So our burn rate looks at the cash used versus the cash generated. Ultimately, we want to bring in more money than we are giving out. So we want the cash used to not be equivalent to the cash generated. How quickly are we going through it? If we have a high burn rate, if we're using up more cash than we are generating, then we're going to become insolvent. We're going to go out of business. So if we take the amount of cash we have on hand and we divide by the burn rate, that will really tell us about how many months our organization has left to operate. When we look at inventory, we look at inventory turnover. So inventory turnover is how quickly we go through our inventory. If we have a high inventory turnover, that means that our products are in high demand. As soon as we make it, we sell it, it's out the door. If we have low turnover, then it could be that there's not much demand for our product. It could also mean that we're making too much or that our production process is inefficient. We've stockpiled too much raw material. There are too many bottlenecks or disruptions in our production process, so there's a lot of work in process just sitting there. So half-made gingerbread houses that are not completed and ready for sale. So if we have a low turnover, we have a lot of inventory just sitting there. So we often look at what is called days of supply. Days of supply takes the number of days in a year, for example, or the number of days we're operating, and divides by the inventory turnover. It tells us how many days worth of supply we have. How long does it take to get rid of the inventory we have on hand? We can look, for example, at some different industries to see what is happening in terms of their inventory turnover. So retail, for example, has an inventory turnover of 10.86. If you take 365 divided by 10.86, you'll see that they restock their inventory about once a month. If we are looking more at food production, then that days of supply is going to be even shorter. If we look at places like Subway, they're restocking once a week. So they're going to have a much smaller number of days of supply, which means their inventory turns are going to be much higher. So in terms of the turnover, where we go through all of our inventory, we're going to do that more times per year. If we look at luxury high-end goods, so if you're thinking like Tiffany, Burberry, we're looking at luxury items. So if you think about like at West Ed, you look at these fancy shops that there's like nobody inside, there's a security guard at the door. Their inventory turns are much lower. They sit on that inventory for a long time. It just sits there, which means their days of supply is much longer. So they go for months with the same inventory, not turning it over. So we can look at different pieces, and here we've been focusing on asset management. We can look at our inventory, we can look at our cash to help us understand what is happening to our organization. We'll look at one more related to our asset management, and then in our next video, we'll dive into the financial ratios. We look at how the assets, liabilities, and equities compare. So the last one that we're going to look at here as we end this video is a cash flow analysis called days to pay. Now this can be a little bit tricky because the formula we're looking at says accounts payable, but it's important to recognize that with days to pay, we're looking at how our customers how quickly they pay us. When we look at how slow our customers are in paying the money that they owe us, we're actually focused not on accounts payable, which is the amount we owe to others, but on accounts receivable. So when we talk about accounts receivable, that's customers owing us money. And in this formula, the AP, accounts payable, is their accounts payable. That's when they owe us. So AP for your customer is AR for you. So days to pay takes 365, or the number of days you're in operation in a year, divided by your AP turnover. So this is the purchases by your customer and how long on average it takes them to pay you. So we look at purchases divided by the average accounts payable, gives us AP turnover. So how many times a year are they paying us? And if we take 365 divided by that, that gives us the number of days. How long does it take the customers to pay us? So their accounts payable, our accounts receivable. If your customers are taking more than 60 days to pay you, that becomes problematic for your business's operations. So you're not getting money in time to use it. And so organizations, including accounting firms, will have dedicated people whose job is in charge of making sure the customers pay and keeping track of the days to pay. And so often what will happen is if the customers don't pay within a certain amount of time, say 90 days, then it goes to a third party to try to get payment from these individuals. In our next video, we're going to look at financial ratios. So if we're looking at how well our business is functioning, are we getting the money we need to operate? We look at a number of financial ratio calculations. And we want to compare how well we do as an organization to industry benchmarks. So we're going to use some Industry Canada benchmarks to see how well we compare for these ratios. So that'll be in the next video.